We are live. I'm excited. We got to bring the energy here.
Woo!
Right,
Woo!
Raquel?
Party on a
There
Thursday.
you go.
Well, aloha and congratulations on taking the time to invest in yourself today. My name is Zasha Smith, and we are Rise Capital Investments. I'm excited for you to kind of get to know the faces behind our real estate debt and equity fund, share the benefits of passively investing, and present the opportunity to help you grow your wealth. So just a little overview of our fund. We're a private real estate fund. We focus on debt and equity, help you diversify, and we want to help you get high returns, less risk, and also give back in whatever way possible that you can. We want you to get cash flow, and of course, we all want to grow and give you more options.
Alrighty, the fun stuff. Hi, I'm Raquel. I'm just going to go over some of the legal disclosures that we need to address. This presentation is a confidential presentation, and the information should not be shared or written without our consent, please. This presentation is intended for accredited investors only under the Rule 506C of the Regulation D of the Securities Act. So, please just keep that in mind. If you are accredited, this is for you. The presentation is for informational purposes only, and it is not a solicitation of an offer to buy securities. Investments are subject to risk, and there are uncertain outcomes. So we do rely on forward-looking projections. And it's critical to conduct your own thorough research and analysis before making investment decisions. We are not investment advisors or financial advisors, and we strongly recommend that you consult your licensed professionals regarding tax, legal, financial, business advice before making any investment decisions.
All right, now that we got through the fun part, let's jump into getting to know a little bit more about our fund, Rise Capital. I'm super excited to, talk a little bit about our customizable growth and income fund. So this fund is designed by investors, right? This is a group of investors. So we want it to really deliver both growth and income, which, were things that we focused on as investors. So the way we do that is we're very strategic with the type of, real estate investments that we do. And we try to focus on high demand regions and, sectors as well. So the places that we target really, Mountain West, Southeast, and Hawaii, obviously, because our team, half of it is from Hawaii. So just states like Utah, where a lot of us live in, Idaho, or Texas, where we have our RV park in, and some of the southeastern states we also target. And our investments, we're really focused on two major categories. One of them is residential and commercial renovation and construction loans, which we're very excited about because we invest up to 70% loan to after repair value. So we feel that it's, safer that way. And we're very excited about this specific type of investment. Also because we have first lien position. So, we have the senior debt usually. And, our returns, the returns to our investors are usually 10 to 12% annualized interest. And then the second category that we focus on really, is commercial equity. We all love commercial real estate here. And so we like to diversify. So we focus on multifamily, we focus on RV and mobile home parks. We also focus on industrial and triple net lease properties, which we feel, most strongly about and understand the best. And we target returns, between 15 and 22% internal rate of return for these types of investments. And then our fund is structured with a total of $15 million, where the maximum investment per person or entity we take at any given time is $2.3 million. So per person or entity. And the minimum really that we take is per person or entity is $50,000. That's the minimum placement to enter our fund. And because we are a group of investors and we focus on diversification, and this is a true diversified fund, you have a minimum of $10,000 per investment that you can choose. So you don't have to, you're not forced to use the whole $50,000 initial investment. If that's what you're going to contribute first, you don't have to use that whole amount in just one investment. You can contribute towards different investments, and the minimum is $10,000. So this flexibility really allows investors to participate, across a wide range of deals, from high returns or just stable and, secure collateral and have real estate as the main backbone of their investments. You can move to the next slide. Yeah, so I'm going to get a little bit deeper into how each of the investments that we work on, what we focus on, and what types of returns. So, let's dive into the, two key opportunities that we work with, right? So first here, our short-term real estate lending, where 10% annualized return, if people are investing below $200,000, they are going to receive 10% annualized return on that investment. And if they decide to contribute over $200,000 per investment, they're going to receive 12% annualized return. So this is a fully customizable, like I mentioned before. Investors can really choose, individual properties, or they can opt to really, roll their investment into a continuous reinvestment deal. That rolls my tongue. So they can, choose to diversify into different investments, or they can just roll and continue, to reinvest. Because this is a shorter term investment, we focus on, 6 to 12 months, but usually we close on these deals after 6 months of the money being invested, usually on average, but it can go up to 18 months. And as far as management goes, for this type of investment opportunity, we do in-house management just for a more streamlined process and just a better control overall. We only do these types of investments where we can visit and we can see these projects, right? Because we are very diligent to, our money and our investors' money as well. And like I said, this is a shorter term investment. So people usually will roll into the next and the next. So we do, 2 to 3 of these deals per month. And then jumping into our second investment opportunity, where we offer our long-term commercial equity. And we focus on, so for investment below 200,000, we focus on a 12 to 18% return for the time of the investment. And for investments over 200,000, we target 15 to 20% return. And then again, we love diversification here. So it is fully customizable as we focus on, U.S. commercial properties, where, again, multifamily, industrial, RV, mobile home parks. And as far as management goes, for this type of management, for this type of investment specifically, we do the management through joint ventures, which, is just best in class operators. So due to our network and connections, we feel stronger about doing these partnerships. And we just feel like it's safer overall. And this type of investment, different from our short-term real estate lending is a longer term investment. So, your money will be in the deal, anywhere from 3 to 7 years, just for greater appreciation. So that's what we focus on. So it's a true diversified fund. We do have a side where it is, shorter, you're more liquid, and we do have a side that we let your money sit and grow, with appreciation as the years go by.
All right, well, let's introduce the team. Kind of give you a brief explanation of our fund, but let's introduce the people behind the fund. So first, we've got Chris Borden. He has a lot of experience as a CEO. Over in Hawaii. He joined our team and brings in his experience. He also is our debt guru. He's been doing debt investments for quite a while, doing these short-term loans, and has been an amazing asset to the team, bringing that experience into it. We've got Emma Powell. She's my wife, and she is one of the minds behind the company that helped kind of conceive this. She's got a bunch of experience in multifamily and a diverse portfolio in a bunch of different areas in investing. And between her and Chris, they pretty much cover the gambit and what needs to, or what it means to invest into real estate. We've got Zasha. She was one of our I guess you could say social media stars. She's been investing for quite a while, and she has quite a large portfolio with the people that she's been running a kind of an education program to help new investors get into the industry, and has been doing a wonderful job, and has been a great asset to us as well in bringing in new blood and helping people understand the industry and bring us into our fund. You've heard from Raquel a little bit there. She's our chief compliance officer. She's definitely on top of things and keeps us keeps us legal. So anyway, she's also has a background in real estate investing and in the corporate industry, and has been instrumental in making sure that we're walking the straight and narrow. There's me. I actually have the background in automation and IT, and I've been doing that for 15 plus years, and have brought that into our business. Not only my IT and automation experience, but the security and making sure that we're staying up with the current security challenges with AI and with the everything that's always going on. So anyway, and then we have Lais. She's been instrumental in helping us to develop these relationships with our investors and to stay on top of maintaining these relationships, and has been invaluable in that aspect of our business. And this team, between all of us, we have 20 plus years and millions of dollars of investment experience. And our desire is to help people. I mean, that's the reason we started out here. And each one of us, the reason that we joined this is because our desires meshed so well. We just want to reach out. We want to help people become independently wealthy so that they can pursue the dreams that they have in their lives and not be tied to their 9 to 5.
So why invest with us? Like Troy just mentioned, and Lais, diversification is a key principle in investing. And that's why our fund's investment approach in both debt and equity is key to help minimize the overall risk and maximize your potential returns. So we have different private loans that give 10 to 12% in a shorter time frame. Then we do have equity deals that give more diversification, and you're investing into these larger assets that take a little bit more time, but then you also get that depreciation aspect. And we are experienced, like Troy had mentioned, and then we are also securing your funds because we are in first lien position of the debt. So that means we get paid out first, which gives our lenders more security. And like you mentioned as well, our whole mission is to give back, make an impact, build wealth, but also make sure that we're taking care of our families, our communities, and freeing up our time through our investments to have a greater impact on the world. So like I mentioned, just that positive impact. We look for investments that will contribute to things like affordable housing and social needs. I personally grew up in low-income housing, and it was always my passion to be able to help those who are struggling. But it's hard if you're struggling and just living paycheck to paycheck to help anyone else. So that's where I knew I needed to grow. And it's very difficult living in an expensive market like Hawaii, really to have enough time to help other people or the finances. And so that is something that is near and dear to all of our hearts. We are a minority and female-led team. Majority of us are dedicated to fostering just that inclusiveness and providing diversity in the investment industry. And we're also environmentally conscious. So we definitely prioritize those projects that maybe have some solar installations or incentive to reduce the carbon footprint, aligning our investment strategies with more long-term environmentally stable goals. We have a strong compliance culture with, thank you, Raquel, for keeping us kind of in line with that. But we also really want to have to integrate our principles in our investment approach. So we want to create value not only for our investors, like I mentioned before, our communities, our environments, and that truly is what kind of sets us apart from other funds, is that we want to make an impact, but also, you know, use our wealth to do that and create long-term success for our investors as well. So our portfolio, these are several different types of deals that we do. We wanted to just briefly go over just some things that we've learned, some things that went well and didn't go well. I know a lot of us in the past had invested in kind of apartment deals. I don't know if you heard lately in the news that some of those partnerships didn't go well or have been through foreclosure. And so that's why we have learned specifically to look at the management team, their experience, how they're going to deal with the asset after, you know, it's under renovation or leasing up the tenants. And we have more in-depth checklists than we ever did before, just so that we are more conservative with the deals we do take on. And we've done multiple deals together as a group and gone full cycle, especially with debt because it is shorter term, but we've gone full cycle on some equity deals as well. So our fund really targets these specific returns. And just to keep in mind, this gives you an overall picture of the blended returns based on you investing your funds into all the deals our fund has to offer. The beauty of our fund, though, is that you get to pick and choose where your money goes, whether that you want to be more heavy in debt or you want to be more heavy in equity. We give you that choice. So our typical cash on cash return is about 8%, our IRR. So is about 15. So we just show this to you guys that this is what we do target, and we'll cover this more in detail at the end.
Alrighty, so I'm just going to cover a little bit about our target market statistics and how we find markets that we want to invest into. So these are the key market statistics that we focus on when, again, targeting investment opportunities and what it is we are considering when analyzing investments. So these statistics ensure that we're adhering to the basic principles of supply and demand while also considering different risk factors. So in regards to, for instance, I'll kind of go down this list and just briefly touch a little bit on each. So steady population growth and net migration, we're really monitoring the population changes and targeting markets that have population growth and taking into account the number of people that are moving in and moving out. This really indicates growing demand for real estate, specifically housing and commercial spaces. Next, with employment growth and economic diversification, areas that have strong employment growth tend to see rising wages, which further boosts real estate demand and overall economic activity. So we're really paying attention to that growth and diversification. So markets with a variety of industries that aren't dependent on one specific industry. I think we lost Chris. We lost our tech. We'll get that back up for you. But the next one was, so we're not depending on one specific industry in a specific market. We want to make sure that we are looking at employers such as like technology, healthcare, manufacturing, education, whatever it may be. We want to see a variety of different employers in the area, which makes it a market less vulnerable to economic downturns. And this type of a diversification provides stability and support and provides consistent demand across different property types. When it comes to positive absorption rate, it means the properties are being rented or sold quickly. So with less inventory sitting on the market. So we're making sure that properties are moving quickly throughout a market when we're analyzing it. This is a key indicator of strong demand, and it suggests that new developments and investments can fill quickly while minimizing vacancy and overall boosting the income. Next, safety is top priority, not only for us and our properties themselves, but for the renters. So you're going to have higher occupancy when you have homeowners and businesses that feel safe in the area. So we target, again, low crime rate areas that are attractive to tenants and buyers, and again, contributes to the overall property values and maintains a stable tenant base. So these things really indicate the strong tenant demand overall, a lot of these factors. And so really what we're doing when we're analyzing all of these different statistics is we're trying to nail down what the demand is. And so it again, demand is crucial for minimizing vacancy, ensuring stable cash flow, and making sure that we have predictable and steady profits in the end. And we understand these demands by understanding the local population needs, which is, what are the demographics of the population, what are their income levels, what type of housing are they needing. For example, a young growing population may drive demand for multifamily housing, while an aging population may have an increased demand for senior living communities or healthcare real estate. And so we really pay attention to that. The next thing is the mortgage to rent spread. So this is really the difference between the mortgage payments and the rental income. Favorable spread is where the income comfortably covers the mortgage. So this specific metric provides investors with steady cash flow, and even again in a fluctuating market. So we want to make sure that there's a good buffer between our mortgage payment and how much income is coming in. So yeah, again, we closely monitor We also closely monitor the loan to value percentages when we're providing loans to borrowers. This allows us to maintain a balanced risk reward profile within the fund itself. And then the last thing that we look into is favorable regulations. We look at local, state, and local and state regulations when it comes to laws and restrictions in specific markets, such as like landlord-friendly tenant laws, zoning policies, tax incentives, things like this. These regulations can make a significant difference when it comes to operations and to profitability. Next, I'm going to touch on the market specialization. I can't talk today. Sorry, guys. But really, our approach to market specialization focuses on selecting properties in markets where we understand the local economy, the demographics, and the property trends. So again, going back to our target statistics that we look into, we want to understand the markets in depth, and this is important in case something happens with the property and we need to be able to take over the property. We need to be capable enough to step into that position as an operator of the property. And why is this important? It's important because, you know, while real estate is an amazing investment opportunity, it is a great, you know, stable investment. There are things that are unpredictable, and even in the best laid out plans, that we may encounter obstacles. And by specializing in markets where we can execute a hands-on takeover, we minimize the downside risk and protect our investors' capital. So this allows us to pivot when we need to and ensure a long-term success in the investment, even in unforeseen circumstances. And this means that we can concentrate our investments in these specific regions where not only we understand the local markets, the local market dynamics, but such as like property values, demands, regulations, but we also have experience and relationships in place to ensure that we can effectively manage the property again if the original plan encounters those types of obstacles. So yeah, just to sum it all up, market specialization is not about knowing where to invest, but it is about being prepared to take decisive action when needed. And so we take this, very seriously, and this ensures that we can maintain control of the outcomes of our investments, and we can proactively manage risk, and that will lead to more consistent returns for the long-term stability of our investors. So the next thing is going to be that I'm going to talk about is the investment principles. So the majority of our investments, we serve as the main general partner, and meaning that we are responsible for overseeing the entire project from the acquisition to the management to the eventual exit or sale. And as GPs, we take an active leadership role in making key decisions and ensuring that the projects stay on track to meet financial goals. But however, we also recognize the value of collaboration and diversification, as you've seen. And for this reason, with some deals, primarily equity investments, we invest alongside other general partners where we act as a co-general partner. And in these cases, we partner with established GPs who have deep expertise and proven track record in their specific markets and asset types. And by investing both in our own deals and alongside other experienced general partners, we leverage everyone's knowledge, everyone's resources, and we can really manage risk effectively while taking advantage of all the diversification and specialization between all of the general partners. So again, this dual approach gives us the ability to diversify across multiple asset types and multiple markets. And we really embrace the collaboration, and it gives us the opportunity to cultivate a stable fund with reduced risk and above average returns. So for the sponsor, you can see here in this table, again, we talked about having experience, track record, but really what we're looking for is trust. We need to trust that the sponsors are going to make the right decisions no matter what the circumstances are. And so we love seeing track records and everything, but we go with our guts as well. Is can we trust what they're saying? Are we going to trust that they're going to make the right choice when it comes down to it? Again, the market we kind of touched on before. We do in-depth analysis of the markets. When it comes to assets, we're not really tied to any one single asset class. Instead, we focus on thoroughly assessing opportunities based on the quality and the potential of each individual opportunity. So our team carefully evaluates like factors such as property conditions, the age, the location, growth potential, and comparable properties. And so we're able to, take each deal individually and determine whether we think it's a good investment for the fund and for you as investors. This allows us, again, to invest in a range of opportunities, including things such as the high-end renovations, new construction, light or heavy value-add properties, and gives you that flexibility to ensure that you have a diversification fund within real estate. So yeah, again, around where we choose different, we may have different sponsors, we may have different asset classes, but we also have different business strategies which are being conducted in each property. So some of the principles may vary, but one thing that is consistent is the financials between all assets. The financial analysis really dives into the deal metrics. We stress test the performance of the properties. We include buffers to account for unexpected changes in things like taxes or capital expenditures or market vacancies. So we want to make sure that it will perform even if, again, the unforeseen circumstances are realized. So we want to make sure that we're testing that. In addition to our underwriting process, we examine the potential risk related to hazards and insurance coverage as well. So our due diligence and underwriting process is very thorough. We lean on the conservative side when it comes to vetting opportunities. Again, just to make sure, our goal isn't to just have the maximum returns, it's to have that stability and reduced risk as well. So next we're going to talk about the capital stack. Yeah, like I've said before, you've noticed that we talked about our objective as a fund is diversification within real estate. And really we have achieved that by diversifying within asset classes, between markets, various strategies. But now we're going to go a little bit deeper and diversify in the capital stack itself. And you probably already know what this is, but if you're not familiar, the capital stack refers to the different layers of financing in the real estate project itself. So it represents kind of the hierarchy of investor claims on the property cash flow and also repayment. So you can see in this image that the capital stack includes debt and equity, and the senior debt is typically at the bottom as it is it has the highest repayment priority, but it carries the lowest risk. So being at the bottom means that in the event of a liquidation or a sale, the senior debt holder is the first to be repaid. However, if they also receive the lowest return compared to the other layers, such as the mezzanine debt, preferred equity, and common equity. So the higher up in the capital stack, you carry more risk, but the profitability is higher. And of course, as a manager, we prioritize our investors' capital and our investors' returns above our own. So we're paid last on the totem pole, and we hold the most risk. But we do benefit from the profits as well. So you can assure that our interests are aligned with your interests in making this investment profitable.
Okay, now maybe it's my turn. So I think I'm gonna switch it up a bit. I want to ask Zasha a question. Zasha, why do people invest, period?
I think they want to grow their money. They want to see some sort of return.
Yep, for kind of wealth generation. Why do people not invest?
They might be scared to lose money and of the risk.
Exactly. So I think that's like the underlying thesis and focus of why we created our fund and why we created it the way we created it. I'll talk a little bit about the different kind of segments of how we do it, why we do it, and kind of how we do it. First off, it is to mitigate risk. If you were to go to Charles Schwab or Edward Jones, you would sit down with a financial planner, and the financial planner would try to assess where you're at in your risk return profile. Well, with your risk profile, and typically normally has something to do with age. I mean, normally if you're younger, you have more time to recoup of a catastrophic loss. If you're older, you don't have as much time. So depending on where you're at, and then just honestly, it just kind of depends on you as a person. Do you want to take more risk or do you not want to take more risk? And that's why we set it up that way. So, and again, if you go back and look, you can just Google what is the most utilized portfolio in the US. I don't know what it is worldwide, but I know in the US it's a 60-40 portfolio where 60% of your portfolio is in the stock market or the equity market, and the remaining 40% is in bonds, treasuries, T-bills, some kind of financial stable asset. And then again, that changes depending on where you're at in your investment horizon, which is kind of the biggest reason why we configured the fund the way we did the fund. Now, when we look at it, okay, just if you want to just say 60-40, again, it is the typically more popular portfolio out there. If I look at like a 60-40 portfolio and I look at the money market account, your typical money market account, and what that yields, I think in the last 10 years, please don't quote me on this, but I think in the last 10 years, it was under 3%. Something like 2.8, 2.9% annualized yield on the money market account. So that's the 40% of your portfolio is typically earning 3%. On a good day, it's 30. Well, actually, now I think it's up to about 5%, but typically through your normal investment time horizon, you're somewhere around 3%. Thus is where we say residential real estate, but theoretically it's debt. We invest in debt. We invest in residential real estate debt because we have a lot more opportunities and deal flow within the markets that we operate in to be able to acquire these assets. And the way we collateralize the investment against the asset makes it there's no such thing as a safe investment, but it makes it safer in the risk return profile. Later on the slides, I kind of go over how we measure the risk return profile and even maybe compare it to the S&P 500. But your S&P 500, which is normally the 60% of your portfolio, has performed very well. So I think especially in the last year, 2022 was not a good year. It was down. 2023 and in 2024 subsequently were both 20 plus index years. So these are good years. Now, if I look at, like, again, you're investing for a time horizon. Nobody invests today and then they're done. You're investing for some kind of time horizon, whatever it looks like. So just using like a 10-year as a benchmark, I think the S&P 500 10-year, if I include dividends, if dividends are reinvested, I think it was about 12.9%, somewhere in that ballpark, which is a really good return. But now if I flip the script and I switch it into alternative assets, now it's looking a lot different, right? I'm taking the money market account, which I would normally earn 3%, which most average profile that you're going to have with these financial planners are going to yield you that 3%. And instead of the 3%, now we're flipping the script to alternative assets and we're getting 10 to 12%. And then on the 60% of the portfolio where you would typically earn, again, on the 10-year S&P 500, again, only about 18% of mutual funds has outpaced the market. So normally it's under that amount. I'm just going off of the historical returns in the S&P 500. So most people don't earn that amount, but even if I quote that amount at 12%, the lowest type of equity asset that we're going to target is 15%, and that's going to be on a safer side of the risk return profile. But you're going to have a range from 15% to 22%, which again makes it sort of like I'm going to take what I would normally do in my equity market portfolio, and I'm just going to navigate that over to alternative assets. Now, I'm not saying yank all of your portfolio and move it over to real estate, but try to diversify a portion of it, especially if you have a self-directed IRA or an IRA that you can roll over to a self-directed IRA. But kind of a synopsis of, I guess, switch it up, kind of a synopsis of kind of our fun, why we're doing what we're doing, and how we're trying to help people improve or at least advance their wealth journey. Because again, it's about having, we're all growing wealth. We're in the equities market. I mean, my financial planner was getting me about 6% return on my capital that I was giving him. Now, what if we can magnify that and 3 to 4 or 5 times that within alternative assets? How much quicker are you gonna get to the end of your wealth journey? Because someone is on their wealth journey only because of something else, some other desires, some other things, some other fulfillment they want in life. For a lot of us, it's philanthropy work, but it could be something different to you. But it's just going to advance you on where you want to and how quick you want to get to wherever you want to get to. Okay, so why again? How do we do the residential? Let's call it debt. It's more like debt investing. We're first lien position on these properties. Borrower comes to us, and we're going to fund a renovation project. They're typically renovation projects or brand new construction development. And what we're going to do is we're going to collateralize that against either cash or another property, as well as the subject property. So like I think Lais talked about it a bit before. There's like normally a percentage to the total value, and actually we lend at 65% loan to value. That 65% is typically the maximum we're going to go there. If it's more than that, we're going to cross collateralize it against something else. And if not, we're going to ask the borrower to bring more capital to the deal. And again, what that does is it mitigates any additional risk that we potentially will have in any type of downturn swing or any kind of other issues that the borrower might come into, any unforeseen issues, foundation issues, whatever the case might be. We still have a large enough buffer to mitigate us from, again, any potential risks that are out there. Historically, in a 6-month period, the market has never dipped by more than, I want to say 20%. It was the furthest dip back in 2008 during the great financial crisis. But nothing has ever dipped past that in a 6-month time frame, which is typically the time frame that we lend on our property, on our debt notes. They're typically 6-month terms, and capital comes back. So again, short term, faster return. The one great thing about it is it's a fixed rate of return, right? It's just, so Raquel talked about the capital stack. Typically on your senior debt, it's a note. It's a note that a promise to repay. Again, normally a promissory note, and it's a promise to repay, and then the terms built in. So we're going to build in the terms. The terms are normally 6 months, and normally whatever the percentage is. And again, it's a fixed income. So when they sell it, when the borrower sells it, they realize the gains or the losses. And we would realize the return of the capital as well as whatever details are in the promissory note. I kind of went through most of this. They're all short-term loans, first lien position collateralized. So again, we put a lien on the property, and they're normally numerical liens. First lien is typically the lien position. I don't think we've done a second lien position within the fund. I've personally done them. Not a gigantic fan, so we try to stick to first lien positions as much as possible, unless it's super highly collateralized. If it's very highly collateralized, then we probably would be okay going into a second position. But again, obviously, we would note that to whatever investor partners that come in. Benefits, again, the yield, the amount of yield that we get. Again, I'm comparing that to a money market account where I'm going to potentially earn 3% versus 10 to 12%. Again, 3 to 4 times the return of capital. Again, just imagine what you can do if you took whatever money that you're investing now and be able to get that return 5 times faster. And that's basically what we're doing. And we're still diversifying it. So we have that diversified portfolio between debt and equity, and being able to magnify your wealth journey that much faster. Loan types, I kind of went through it. We've done commercial loans. We typically do residential renovation loans, but if we have a good partner, which we know, like, and trust, and the fundamentals of the deal, which Raquel talked about a lot, if it hits those metrics, then we'll go ahead and do a commercial deal as well. Next, we're talking a little bit more about, and we talked about this to a decent amount of degree. Now, this would be the other side of that portfolio that I was talking about. Again, everyone's in a different place in their investment journey. Our portfolio is more, I would say, probably 75 to 25%, being 75% being debt, 25% being equity. And the bigger reason behind that is, one, on the debt side, it's consistent cash flow. If you've invested in multifamily, depending on where it is, there's a good high chance that your distributions have frozen. Not everyone. Again, it's just dependent on exactly when that investment happened, your sponsor, the market that you're in. There's a bunch of considerations, but a lot of distributions have frozen. And reason being is they want to be able to protect and it's done to protect the asset, protect the investor's interest as well, to mitigate any types of cycles. Now, if you're not having that cash flow and you need the cash flow, that's where the debt side would come in. Again, they're guaranteed payments, they're promissory notes. So it's going to mitigate that downturn. If I'm looking at it holistically as a total portfolio, now, again, because we have that as a vehicle, we can be a lot more finicky and picky with the assets that we're looking at. We can pass on assets that maybe another fund or another sponsor or syndicator might not necessarily pass on, because they need to get deals into the pipeline to suffice their investors' investment goals or appetite. Again, we can be more picky with them, so we can look and say, yeah, this is a decent deal, but I want to get one that's going to hit it out of the park, and get more picky on the types of returns, cash flow, risk mitigation, so on and so forth. But again, we like to look at it as diversification. Raquel mentioned it. We're pretty agnostic on the types of assets that we look at as well, both the asset type as well as geographically, because again, it's just diversification. You can have 2008. I'll just use 2008 financial crisis. If you guys were to go back and look at 2008 and look at Austin, Texas, it outperformed almost the rest of the country. However, if I look at last year and I look at Austin, Texas, not so good. So every single market is different. They're all cyclical, and they don't all perform the exact same way during different downturns or upswings. So understanding that, and no one having a crystal ball, you can do as much research as you possibly can. You can still make mistakes. There's no such thing as a crystal ball. So why not be able to diversify between geographical locations as well as the different assets that you're looking at? Whereas a multifamily might not be doing good, but industrial, especially with, I'm looking at data centers, are absolutely on fire. Like they can't produce enough. BlackRock just announced $100 billion capital raise for more data centers. So again, it's just not all one asset is going to perform the same during different cycles. So we like to then again diversify our entire portfolio, and diversify between debt and equity. And then in the equity side, we want to then even diversify more into the geographical locations and the different asset types. Okay. I pressed the wrong slide. Tax benefits. So full disclosure, we have zero tax benefits in the debt side of things. Interest income is taxed as ordinary income, which is again why we configured our portfolio the way we did. We can use the equity side of it to offset any type of gains that you potentially have on the debt side of things. So now there's ways to invest, especially with an IRA. So if you have an IRA and you wanted to invest in alternative assets, I would definitely look. If you're still employed with the employer that gave you your IRA or 401k, I would definitely talk to your plan administrator and see if you have the ability to roll it over if alternative assets or real estate interests you. You might have the opportunity to roll it over, or if you had a pre-existing 401k or IRA from a previous employer, you can definitely roll that over. You roll that over into a self-directed IRA, and now you can enjoy interest income without having to pay the taxes on it. So there are opportunities on the debt side of it, but if you're just normally, you're going to use the equity depreciation or any type of passive losses within the entity to be able to offset any type of interest income you have. So there is still a lot of opportunities, especially with depreciation. We still are able to utilize 60% on the cost segregation or bonus depreciation, which means that we can depreciate the asset, 60% of the asset, typically upfront in year one, which is a super powerful tool if you're trying to mitigate any type of capital gains tax that you might be experiencing. Again, not going to necessarily help with ordinary income, but capital gains, it's definitely an opportunity for you to reduce your overall tax liability. And honestly, with the way it's structured, again, as I mentioned earlier, it's a way to be able to grow your wealth much more efficiently, effectively, and honestly, just faster, which is probably a bigger reason why we all got into it as well. Again, values align, but with capital, I can't remember where I heard the saying, but the more money you have, the more opportunity you have to do good. So, which is again what we're trying to do. So we're trying to expedite that wealth journey for ourselves as well as others, so we can all just do good together. Ultimately, at the end of the day. Okay, we talked about this somewhat. I can't remember who exactly was talking about it, but this is the overall fund profile. And one of the things I think a lot of times I talk to investors a lot, and typically they're looking at the returns and not necessarily understanding that there are risks. So like Raquel talked about it, especially on the capital stack, there's risk on the types of assets that you look at. There's risk between debt and equity. And even between on the equity side, there's risk between the different assets that you're looking at. And they all carry different risk profiles. So understanding the risk profile is pretty important. And that's why we diversify. There's such thing called standard deviation. And basically standard deviation is kind of just a measurement of the ebbs and flows, both up and down, from the median return in any type of investment. It's used a lot in the equity market. You typically compare it against the same type of investment. And so again, this is all commercial real estate on the equity side, both equity and debt, and we'll just lump debt into the commercial side of the spectrum. As we're looking at this, again, just looking at the risk return profile. But again, a standard deviation is just a measurement of volatility or the ups and down swings that an investment will be from the median return. Now, obviously, if it swings up and down and it closes, you really don't know exactly what the return will be. Obviously, there's a median return, but it could swing up, it could swing down. The one good thing about real estate typically is you can hold the property and then mitigate any types of ebbs and flows within the standard deviation typically, but just say hypothetically you can. And these are actual numbers from the National REITs Association, which measures thousands and thousands of assets and where they were on the exit and the return profile of these assets. So we're looking at them, and I can clearly see, so the higher the number, the higher the deviation from the mean. So I can clearly see just by looking at this, like storage as an example, has a 16% variation from the mean. So it can go up 16% or down 60%. Large variation profile. Now, loans on the debt side, it's a promissory note. So it's an agreement to return payment. You're not going to have that much deviation from the typical return profile. So again, there's no good and bad when I'm looking at standard deviation, because the standard deviation could go higher. Theoretically, it could go higher because it's measuring the upswing as well as the downswing from the median or the mean. The better way to look at it is looking at what's called the Sharpe ratio. And again, the Sharpe ratio normally is only used on similar types of investments. So again, this is commercial real estate, so we can use it. Now I'm looking at the Sharpe ratio, and super quick, Sharpe ratio is just a measurement of performance against the risk return profile. So I'm taking the return of whatever I'm investing in, and I'm going to subtract the risk-free rate, which is, I think it was about 4.9, which is normally the 10-year treasury. I think it was 4.9 as of today. And I'm going to divide that by the standard deviation. So the higher the Sharpe ratio, the greater the return to risk profile is, meaning I'm taking on less risk for that specific return. And as Raquel mentioned earlier, especially on the debt side, it's going to be the lower return profile that you can take. And normally you're using this to measure different types of assets that I'm investing in, which is why this is a perfect example. Not all assets perform the same. Some assets will have a higher standard deviation. Some assets will have a higher or lower Sharpe ratio. And kind of understanding what those mean can help you make better investments. And then again, fast track your wealth journey. Because I know if I'm taking more risk, you also have the risk, as Zasha said earlier, to just lose everything. So there's a risk profile there. And you want to be able to articulate very well to yourself anyway, where you're going to invest your money and where it makes sense. Again, looking at the risk profile and making sure I diversify between maybe high risk, low risk, and even on the high risk side, I'm still diversifying that as well. You're not going to get to your wealth journey fast if you invest and you lose your money. It's about making smart, intelligent investments and diversifying based off your risk return profile. I am done. Felt like I went on forever. I apologize.
All right, so to sum things up here, quickest way to get basically to get into our fund is to go sign up for our investment portal. You can find it at partnerwithrise.com. You can also find it at risecapitalinvestments.co. But Partner with Rise is easier to remember, and so that's why we put it there. So you go in there and you'll see all the list of all of the investments and the deals that we have in your portal there, and you can go upload your accreditation letter and start investing right away. And you can pick out which ones you want to invest in and decide which ones are going to best fit your profile and what your goals are. And then you just sit back there and relax, and you just watch the money come in, and you see the reports in the investment portal, and get your K1s at the end of the year, and it really simplifies things. So thank you for joining us today. Again, here's our QR code. If you want to take a snapshot of that, you can just jump right onto our page right away. Again, our focus here is not necessarily to grow our business, our growing our business means that we're helping more people, and that we're helping more people become, I guess, provide an additional source of income that they didn't have prior to finding us. And the goal is that we want to free people up to be able to follow their dreams and not to feel like that they're trapped in a job or a position where they're not able to do the things that they want to, live the dreams that they've had when they're children. And our belief is that most people out there, given the opportunity, if they didn't have to rely on somebody else to provide their income, that they'd be able to make a lot more difference in the world and help other people out and help other people that are struggling. And that's really what our goal is. So we want to just be there for people, educate people, let them know what's available, let them know how to find that financial independence so that they can go out and make the world a better place. So if that's you, then please reach out to us. We're happy to have a conversation with you and to help you understand or help us understand what your needs are so that we can help you. If that's not helping you directly through what we offer, we're happy to point you to the people that are there that can help you out and to make the network connections for you, because this industry is about making connections and building strong connections and becoming closer together as the human race. So please reach out.
Mahalo.
Mahalo.
Thank you all for coming.
Thanks for joining us.